Okay, and I would like to share the screen just to check. Oh, I can check. I forgot. Is a plus? Yes. I present and I share the screen. Okay, perfect. Now it's done. So for the moment you are 2028. Just I go to Canvas and I present where are the documents. Normally is visible for you in the modules, all the document I put. I forget to put again the slide of the session of today. I changed a few minutes ago in order to have something coherent with Scout. We use Scout during the course. So please, if you can download again the PowerPoint of the session 1, Cash Management 2021, session 1 and 2, students, you can download it now because we will use the last version I put a few seconds ago during this session. So I put document for the session 1, 2, 3, 4, 5. We have 5 sessions together of 3 hours during all the week, from Monday to Friday. And during the 5 sessions, I'm sorry for the syllabus. I forgot to modify the syllabus. I will put the syllabus later tomorrow, I think, with coherent with what we'll see together. I go directly to the beginning of the slide and I will present what we will do together. So you will have one homework to do, maybe not by group of 2, I will say by group of 3, because you have 45 group of 3. So you have to create 15 groups. Maybe we will see with the administrative people how we can do the groups, but we have to create 15 groups of 3 people. The mark for this one is 40% of the total, and you will have 1 month to do it. Maybe we can say you have already a question? I check. No. I don't see a question. It's okay. So you will have to do 1 case study. You have 1 month to do it. I will present the case study at the end of the week in function of what we saw during the week. Maybe in function of your interest, I will propose 1 or 2 case studies. And if I propose 2, you can decide which case study you want to do. Maybe one with a lot of calculation and another one with more interpretations, maybe. I will check what I decide to propose. And 60%, it's a final examination. It's MCQ, like the MCQ we'll do during the sessions. Like the final exam, you have already 1 example in the modules. The last module, pass final examination, I put 1 example with calculation on Excel, with wording, and another one with the solution. So normally the final exam, it's 2 hours, I think. I will check the time you have, but you have the example of final exam. It's a multiple choice question, but in fact is small exercises. And I need to put the PDF of 2 chapters from 1 book, from this book, Finance for Executives. I will give you the PDF on the Canvas for the chapter 4 and 5, chapters relevant for what we will see during the 5 sessions. In the corporate finance book, your textbook normally for this program, you can use the part 9, short-term financing. is relevant for the cash aspects we will see during the 5 sessions. In the 5 sessions, what I propose is first to analyze the statement of cash flows, which is a very important document created by the company about all the cash flows of the companies, operating cash flows, investing cash flows, and financing cash flows. We'll present the difference with the cash budget. In the cash budget, we put the investing and the operating cash flows together, and we separate the receipts from the disbursements. So we'll come back on the statement of cash flows during the session 1, maybe a little of the session 2. I'm not sure we will finish everything today in the 3 hours. In the session 2 and 3, I propose a different approach of the cash flows through the balance sheet, with the transformation of the balance sheet into what we name simplified balance sheet. In this simplified balance sheet, we separate the working capital requirement, and the net cash. So we'll see the liquidity approach through simplified balance sheet. In the session 3, we'll see another kind of balance sheet, what we name managerial balance sheet. With the managerial balance sheet, we can directly calculate and estimate the free cash flow. So we'll see together with the managerial balance sheet what is the free cash flow and how do we use it or finance it. It depends if it's positive or negative, the free cash flow. We'll see some strategic aspects related to the free cash flow through the Boston Consulting Group matrix. It's a whole matrix, but we continue to use it because it's related to the life cycle of the products and the notion of maturity of the products, of introduction of a new product and decline of the product. It's a general vocabulary we use and is related to the free cash flow. In the session 4, we will discuss about how to manage the working capital. And when we manage the working capital, in reality, we manage the working capital requirement of the operating capital.
Excuse me, sir.
Yes.
I think your slide, your screen is freezing because we're still seeing only the slide 2. We tried to text to you, but seems you did not read the text.
You don't see the slide at all?
I see the second slide only, sir.
Okay.
Can you try to reset, because someone cannot see your screen also, so maybe there's some problem. Thank you.
Normally the connection is okay, so I leave the session and I come back to the session, or I stop the PowerPoint and I start it again. And
I think I think you should you better stop and then you open it again.
The PowerPoint, only the PowerPoint.
Right, sir.
Okay, thank you.
You're welcome.
Because normally I share the screen, it's okay. Do you see the PowerPoint now?
I'm still seeing only the second slide, freezing. I'm not sure about the others.
You don't see the slide number 4, brief contents?
No, sir.
Okay. It's strange.
Can you try to read from the text, because people is respond to your questions?
Just the loading symbol. No, sir, I see nothing. I see slide 2 only.
Bonjour, Eric. Can you hear me?
Yes.
You can sign out and then sign in again. Because we cannot see the slide, so maybe you sign out the canvas and then you will sign in again. Maybe it will solve the problem.
Okay, thank you. I will.
We are
I
waiting
leave
for you.
and I come back. I share the screen. My camera, camera font. Okay. No. Camera font, quality. Okay. And I share. Okay. I share the screen. Okay, I put PowerPoint. And I come back to the slide 4. So, do you see the slide number 4 with the brief contents now? It's okay for everybody? I just load the links and in the other case, I don't use the camera. Maybe it's because of the camera. You see the PowerPoint? Slide. Okay. Yes. Now it's working. I can see both camera and slide. Yes, sir. Okay, perfect. So I think the problem is resolved, so we can continue. So I said we see different presentation of the balance sheet with the simplified balance sheet, the managerial balance sheet, and with the managerial balance sheet, we will see the free cash flow is related to the managerial balance sheet. We'll see how to manage the working capital, and when we manage working capital, in fact, what we manage is the operating working capital or working capital requirement. And during the last session, we'll see how to forecast the cash flow directly from P&L and balance sheet. So generally, when we use the discounted cash flow in order to value some company, to have the market value of equity, we create a forecast for the P&L, a forecast for the balance sheet, and the cash account in the balance sheet is a plug. So we'll see this forecasting process. And this forecasting process in reality is related to the statement of cash flow. It's a statement of cash flow with indirect methods. So we'll come back on all these notions during the 5 sessions. So we are not interested by some very technical aspect of the cash with the short-term problem of the cash. You have many models in order to estimate the best cash balance we should have, and for which cash balance we should invest in marketable securities, and what is the cash needed from operating activity, how we can use the excess of cash, and so on. So we have many models about that, and it's not the purpose of this course. So if you are interested by this kind of model in order to manage the cash in the short term, I can give you a book, a link to the book. I can scan some pages of the book, but it's not the purpose of this course. Okay, so we'll not go into very technical equation like that. in order to estimate the best level of the cash we should have. Okay. Just to say, we will not do that. What we will do is to create links between cash flow aspects and the strategy of the company and how we can see some problems through cash flows. So during the session 1, we talk about the statement of cash flow, which is a document is compulsory to create, a financial statement you have to create in order to show the performance of the company. So when we talk about the performance of the company, we think first about the P&L, profit and loss, or income statement. But we think about also the statement of cash flows. With the statement of cash flows, you show the possibility to distribute dividends, the possibility to finance your investments thanks to your operating cash flows, the possibility to repay the debt thanks to the positive free cash flow, and so on. So it's a very important document, the statement of cash flows, and you have to respect some rules in the creation of the statement of cash flows, and we see these kind of rules. We talk about also the IFRS and the US GAAP. Normally in Vietnam, you should apply the IFRS in 2025, and the Vietnamese GAAP are very close to the IFRS. So I will mainly talk about IFRS, but it's relevant for your country because you will apply this one in 2025 normally, and you are already a lot of relations to the IFRS. When we want to analyze the change in cash, in reality, we can use the basic business equation or the balance sheet represented as an equation. In this equation, we have on the left side the assets, what we own, but not only what we own, because we have the right of use assets. It means what you use, but you have to put in your assets. And you have the financing of what you use, the liabilities, and the equity. When you modify your equity thanks to your internal performance, is through the net profit. So you are modifying the retained earnings, or through also other comprehensive income, OCI. Under IFRS and US GAAP, we have OCI. In the assets, you have the cash account. So it's interesting with this equation to check why the cash is not modified in the same way than what you see in your P&L. For instance, in your net profit, you have 100. Why in your cash plus 100, it's a profit? Why you are modifying the cash? So here is a change in cash only by plus 40. In the between, you modify other things. So you must keep the balance sheet balanced. So if you don't modify your cash for the same level than your net profit, is because you already invested in other assets, or it's because in reality you don't pay some expenses. You don't pay some expenses because it's a non-cash expense without an effect on the cash during the period, or it's because of the credit terms you will pay later. So because of the credit terms, you are creating some operating liabilities. Operating liabilities, it means you don't pay interest because of this. So it's a non-financial liabilities. Financial liabilities, you have to pay interest for that. Operating liabilities, you don't pay interest. It's the same on the assets. You have financial assets, you receive interest or dividends, and operating assets. For the operating assets, you don't receive interest or dividends. So operating assets and operating liabilities are related to the sales revenue and the operating expenses. So the operating assets and operating liabilities explain why the cash flow related to the operating profit is not exactly the same than your operating profit. Maybe you will pay later some operating expenses. Maybe you will receive later the cash from the sales revenue, or the reverse is already paid in advance, is already received in advance. So if you decide to increase your inventories, you are using the cash. So if you are using the cash, it's not visible in your cash what you invest in your inventories. Your inventories, when you increase the inventories, is not a part of your P&L. In your P&L, you are only interested by what you sell. So the net profit is in function of the sales volume. If you decide to produce, the production volume is higher than the sales volume, is not in your P&L, but you are consuming the cash because of this. So you are increasing some operating assets. So some cash aspects are not visible in the P&L because they are not related to your sales volume. So we will start directly with one MCQ. You have information about the net profit. You have information about what we decide to do for the operating assets and what we have in the operating liabilities. From the information related to operating assets, operating liabilities, and net profit, so you have information about this one. You can calculate this one. By difference, you can explain why we have this change in operating cash flow. So what I propose is to go to Kahoot. And Kahoot, I will give you the PIN code for this session. So I will use Kahoot all the time for all the session. So please keep open Kahoot during the 3 hours, because we don't start a new Kahoot every time. We start a new Kahoot at the beginning of each session. You will have the PIN code now. Put the PIN code on your smartphone. 654 61 74. So I put also the PIN code here. So put your first name. (1314). You should be 45. During the session, do we have the number of participants? I don't see the number, but yes, 38. So please, very quickly, if you can put your name, Okay, we start. So for the rest, you have already the pin code. On Canvas, you can use the pin code in order to start to answer to the question 1. So question 1, it's about the calculation of the cash flow, operating cash flow with the indirect methods. So we know the profit. From the profit, can you calculate the operating cash flow? So don't forget, it's the same questions here on Kahoot and in the PowerPoint. So you can use your PowerPoint to do the calculation. If it's too small, the wording on this format. So all the information here, it's about the same months. I put October here, maybe in the PowerPoint I put different months, but it's all for the same months. So 2 ways to calculate the operating cash flow with the direct methods or indirect methods. With the indirect methods, so I take the wording from here and we go to the whiteboard. 1. Okay. So the direct methods, so for the operating cash flow, You have the choice between direct methods or indirect methods. Under IFRS, we say it's better to use the direct methods, but in fact, the company prefer to present with the indirect methods. With indirect methods, we want to reconcile generally the net profit with the operating cash flow. Why the operating cash flow is not equal to the net profit. And we consider generally two steps. Step 1, step 2. In the step 1, it's just about what we see in the P&L. In the step 2, is more about a change in the balance sheet. In the step number 1, we add back non-cash expense and non-cash revenue. What we name non-cash means without a cash impact during the period. So a classical non-cash expense is the depreciation and amortization expense. The cash impact is already in the past, at the moment of your investments, at the moment of the payment of your investments. And after this moment, because you use your investments during several years, you have to allocate some cost over the different periods. So you have a non-cash expense because the cash flow is already here in the past. It's not at the moment you put the cost, at the moment you put the expense. So we add back non-cash expense, non-cash revenue. In this exercise, we don't have this part, the step 1. We have only the step 2. In the step 2, we want the change in, normally is current operating assets. And we want the change in current operating liabilities. So now it's something visible in your balance sheet. With two balance sheets, you have the change. So in your net profit, you have revenue minus expenses. The problem is you want to finish with the receipts, operating receipts. Minus operating disbursement. So it's different in terms of cash flow. Your revenue, your expenses are in function of the sales volume. It's what we name the matching principle. You match expenses against revenue, and you consider the revenue because you sell it. What is the problem with this equation, revenue minus expenses? Inside, you have non-cash expense, non-cash revenue. So we have to eliminate. So after the step 1, when you are here, we change the color. After the step 1, you have only cash revenues minus cash expenses. In theory, because we'll see in reality it's a different. So normally what we want after step 1 is only cash revenue minus cash expenses. We eliminate the non-cash expense, non-cash revenue. Cash revenue, it means with an impact on the cash during the period. But maybe your operating receive is different from the cash revenue because of the credit terms. maybe the cash expenses is different from the operating disbursements because of the credit terms, maybe because of the differences in volumes of activity. Don't forget the cash expenses is related to the sales volume, but you can have operating disbursement because of the purchase volume. You can have operating disbursements because of the production volume in your factory. So here is the warehouse. Here is the factory. Or you can have operating disbursement because of the sales volume. Here it's in the commercial department, administrative department, commercial, administrative, research and development departments. So you can have differences in the volume of activities because you don't purchase what you consume, because you don't produce what you sell. You can have a difference in terms of disbursements. The disbursements are not the cash expenses. And the other difference is because of the creditors. So all these differences in the step 2 here is because of the change in operating working capital. Sometimes you can see change in working capital requirement. Sometimes you can see change in working capital from operations. You have many terms for this part. Okay. We use the vocabulary operating working capital or working capital requirement. So what we exclude from the working capital, it's the cash assets, the financial assets with the cash account, with the short-term financial assets, and also the financial liabilities. We don't care about this part. It's not in the step number 1, it's not in the operating cash flow. The financial assets are related to the investing cash flows. The financial liabilities are related to the financing cash flows. And the cash is the bottom line of your statement of cash flows. And with the direct methods, it's easier to calculate it or to have directly the value. It's just what we said, operating receipts minus operating disbursements. So if we come back to the wording, we can use the equation assets equal liabilities plus equity, and also the change in assets is equal to the change in liabilities plus the change in equity. Here we have the change in equity only because of operating activity. So here it's in the operating profit. And we have the impact in terms of profit is plus 600. So we increase the equity thanks to the profit. We have now, and we want here the change in cash from this one. We have also the change in operating assets, and in this one we have the change in operating liabilities. So the information, we have information about the sales. We sell 5,000 products at the selling price of 1, we have the unit cost of 0.88, and we know 60% of expenses are cash paid. The rest is paid later. So here in the expenses, we suppose we have only cash expenses. So because we don't pay these expenses, we are creating some liabilities. So because of the 40% of the expenses not already paid, we are increasing the operating liabilities. So 40% the rest, which is not already paid, of 0.88 multiplied by the volume, 5,000, it's the increase in operating liabilities. And we decide also to increase the inventory, plus 80. The inventories are in the operating assets. So now we can find with the indirect methods, it means with this equation, what is the change in the cash, what is the operating cash flow. So we want the change in cash in function of the profit, which is already a change in equity, and with the change in operating assets, change in operating liabilities. So in fact, here is not just about accounts payable. Here we don't have all the details, so it's account payable, but also the change in accrued expenses. It's more general than this, is account payable and accrued expenses. Okay. We change slide. Oh, this one. Okay. So we have the information of the 80. We have the information about the profit. We have the information about the increase in accounts payable and accrued expenses. So now we can calculate this one. So the change in cash plus the increase in operating assets is equal to the increase in operating liabilities plus the profit. We want to keep only the cash on the left side, so we put this one on the right side. So now is minus. It was plus, so now is minus. So the change in cash is equal to the profit plus the increase in operating liabilities minus the increase in inventories. So you can see the sign is different for the operating liabilities and the operating assets. When we have an increase in operating liabilities is plus, when we have a decrease is minus. For the operating assets, if we want to replace this one by a plus, we have to consider an increase as something negative and a decrease as something positive. So the sign we have here is supposed to be the cash impact, a kind of cash impact. So do we have a cash inflow, the equivalent to a cash inflow, or the equivalent to a cash outflow if it's negative? Okay. When we do that, we use a sign plus. So we put plus plus everything, but before the figure, we put directly minus when we have an increase in operating assets, and plus if we have a decrease in operating assets. So the operating cash flow is 2,280 is equal to the profit plus the increase in operating liabilities minus the increase in operating assets. With the, I forgot to put with the direct calculation, but we can calculate with the direct method. So here it's with the indirect methods. So here we used the indirect methods. So from the profit, if we want to use the direct methods, in this case, we have the operating, or here all the receipts. So all the receipts here is directly the sales revenue equal sales revenue, which is cash received. So here it's the 1,000 multiplied by 1. 5,000, sorry, 5,000 products multiplied by 1, the same price. And in the disbursements, now we have all the cash expense, cash paid, 60% of 5,000 multiplied by 0.88, and we have the inventories plus 80. So the inventories are cash paid. And we should finish with the same. Okay. So normally you have 5,000 minus 2,720,000. This is with the direct methods. So you take what is cash paid, the 60% is cash paid. Okay, the 60% from here. You take the 60%. You know that the revenue, all the sales revenue is collected. So the collection from customers is equal to the sales revenue. Thanks to this, we know that the collection from customers or the receipts are equal to the sales revenue. With the 60%, we have the disbursement, but only the disbursement for the part sold, what is included in the P&L. What is not included in the P&L is the increase in inventories and is cash paid. So also a disbursement. When we analyze, so the statement of cash flows is just an explanation of the change in balance sheet with a cash impact. So you could analyze what is the change in balance sheet, what is visible in the statement of cash flow. You compare the two, and with the comparison of the two, you can try to understand why this part is with a non-cash effect. So it's interesting when you have a balance sheet. If we suppose we have opening balance sheet, opening balance, we have the ending balance. So with the two balance sheet, we can calculate the change. So we can have the change. And beside, you can put the statement of cash flows. And you can try to understand why the change is different from what is visible in the statement of cash flows. So by difference between the two, here we have the number 1, the equation number 1. Here is the calculation about number 2. You can try to explain the difference. 1 minus 2. So for instance, we have the debt, financial liabilities. The opening financial liabilities, it's 800, increase to 1,000. So the change is an increase by 200. And in terms of statement of cash flow, when you see the repayment of the debt and the new debt, you explain only a change by a cash impact of 120. So we have a difference of 80. Why we have this difference? Maybe we have in the reverse. I will do the reverse. We have a decrease. We have a decrease by 200. And in fact, in terms of cash, we paid only 120. We have a difference of 80. So here it's about the new debt minus repayment of debt. The net change in gross debt. So here we can name it net change in gross debt. With a cash impact, okay, with a cash impact. So maybe we have a difference of 80 here because we transform some financial liabilities into equity. So maybe the difference, one explanation. So now we can try to find the explanation. So the difference is because of non-cash effect. So maybe in the explanation we can have here is because the company converts financial liabilities into capital or equity. Okay. So with this transformation, we don't have a cash effect. So it's interesting to do that for many items in the balance sheet. You check the change. You check what is with the cash impact is visible in the statement of cash flow. If we have a different value, you try to explain why we have this difference. Because it's important to be able for the financial analyst, what is with the cash impact, what is without the cash impact. Here, I will keep it. And maybe I will try to put more items. So example of difference, change in balance sheet, and statement of cash flows. When you look at the statement of cash flows, the problem we have is we have too many items. If we look at the operating cash flows, you have a lot of explanation of the differences between net profit and operating cash flow. If you look at the investing cash flows, you have many items, and generally you have less item in the financing cash flows. So you have a lot of details in the statement of cash flow. So what is interesting is to start with the macro level. So the statement of cash flow, it's three parts plus the effect of the exchange rate. We separate the operating cash flow from operating activities, the cash flow from investing activities, and the cash flow from financing activities. With the sum of the three plus the effect of the exchange rate, you have the cash flow of the period. With the cash flow of the period, generally, you want to explain the change in cash and cash equivalents. But it's also possible to explain the change in net cash, which is the change in cash and cash equivalents, minus the change in bank overdraft. So it means it's a negative cash account, so it's a liability, and you explain directly the change in net cash. If you are on the right side, it means the change in the bank overdraft, it's already in the financing activity. On the left side, you don't have the change in bank overdraft in the financing activity. And inside each category, you have many lines items to explain these possibilities. In the investing activities, we have a problem with this classification because we put three different things inside. In the investing activities, we put what we name the net capex, net capital expenditure. It means investments minus divestments in mainly property, plant and equipment and intangible assets. So it's the investments needed in order to develop your operating activity. you have also the business combination. The decision to purchase companies or to sell some business activities. So it's different from the net capex because you are not developing your activities you already own. You are creating some new activities, or you are developing your activities with the acquisition of one entire company. So the business combination, it means you go to external development. You want to develop your activity with external acquisition. And the last one, it's all the financial assets. In this one, you have the change in current financial assets and non-current financial assets. If you look at the business decision in terms of cash flows, is not like this presentation. In the business decisions about the cash flows, you are not saying, I will manage this one first, after I will manage this, after I manage this, I take into account this one, and I finish with the explanation of the cash. This is not how it's done in terms of cash flows. The business decision, it's about the development of your activity. What I need to spend in order to develop the activity. So first, I start with investing activities. In function of this, I will forecast the impact in terms of operating cash flows. With the past investments and the new investments, what I can expect in terms of operating cash flow. So first, I start with the net capex. I want the impact of all the investments, past and current investments on the operating activities. After, with the difference 2 minus 1, I have a recurring free cash flow. Maybe I decide some acquisition, so I can also consider at the same time some business combination. Number 3. In this case, is no more recurring free cash flow, but a total free cash flow I will consider 2 minus 1 minus 3. If the free cash flow is positive, higher than 0, now I can decide to purchase some financial assets, the acquisition of financial assets. If I have a positive free cash flow, I can decide to repurchase their own shares, repurchase of our own shares. I can decide to have more repayment of debt than new debt. I can decide to distribute some dividends. And maybe I want to increase the cash because of new acquisition or because of the need of cash for the next period. So the reality of the decisions, the business decisions of the company in terms of cash, it's in function of decisions about investments, net capex, business combination, the impact of these investments on the operating activities, the capacity to finance the investments thanks to the operating cash flow. If it's the case, I can decide about the financing activities to have negative cash flows in the financing activities. It means I repay more debts than I have new debts. I decide to repurchase our own shares or to distribute some dividends, or the two together. And I can decide to increase the cash. If the free cash flow is negative, so I will erase this situation. So I say step number 1 is here in function of the net capex and I can also have the business combination. I said I will take decisions about investments. I will take decisions about financing activities. I will take decisions about the change in cash in function of the free cash flow. So here, the 1, 2, 3 are in function of the free cash flow. And now the free cash flow is negative. In the situation, the free cash flow is negative. Yes? No? No question? In the situation, one operating cash flow, the free cash flow is negative. You can decision in the relation number 2 to have a sale of financial assets. You decide to sell some financial assets in order to finance the negative free cash flow. You can decide to have more new debt than repayment of debt in the financing activity. To have issuance of shares, no dividends, no repurchase of our own shares. So the treasury stock is a change in treasury stock, no change in treasury stock. And we can decide to decrease the cash if it's possible to decrease the cash without problems. So the decisions about some investing activities, some financing activities, and the change in cash is in function of the free cash flow in reality. In your statement of cash flow, is not visible. In your statement of cash flow, you put all together the different kind of investing activities. Do you invest in order to develop your operating activity? Is included. Do you decide to purchase or to sell some financial assets in function of liquidity problem? It's also in your investing activity. Do you decide to purchase a new company or to sell some business activity? Is also in your investing activity. So in my opinion, the main problem of the statement of cash flow is because of the second category. We should split the second category in two parts. We keep the category number 1 here, but in the category number 2, we split it into two parts. We separate the net capex and the business acquisition, business combination, from the change in financial assets. In this way, in the part number 1, we have the free cash flow calculation, free cash flow. In the second part, now, we have the use of free cash flow if it's positive, or we have the financing of free cash flow financing if it's negative. We will see later when we calculate the net present value of one project. In reality, we don't want all the cash impact of the P&L. In this one, we have all the cash impact of P&L. In the net present value calculation, we want to separate the strict operating cash flow from cash flows related to the financial profit, with interest expense, interest income, and all the income tax. So we don't want, in reality, all this cash impact of P&L in the net present value. So it's also a problem, the way the operating cash flow is calculated when we want to decide about some investing project, and we want to have the impact in terms of cash. So, as I said before, in the statement of cash flow, generally, we have the indirect methods for the calculation of the operating cash flow, with two steps. one is related to the P&L. So all this is visible in the P&L. The depreciation and amortization is in your P&L. Here, if we have impairment of goodwill, it's in your P&L. Provisions are in the P&L. Bad debt expense are in your P&L. Losses, gains are in the P&L, and so on. So the first part is related to the P&L. And we want to eliminate what is in the P&L, so already in the calculation of the profit before tax, but without a cash effect during the period. So after the step number 1, we have a kind of potential operating cash flow. What you can expect from the P&L in terms of cash flow, but maybe you don't have the cash flow now because of the credit terms. So normally you should create, after all this cash flow, but maybe not now. Maybe it's already reinvested in something else, but it's a potential cash flow. In the step number 2, we explain, so here it's the classical step number 2 is here. In the step number 2, we explain the change in current assets, the change in current operating assets, the change in current operating liabilities. So we explain why we don't have the cash flow. So it's just potential after the step 1. The real operating cash flow is after the step 2. So from the profit, we have a revenue minus expense, but we don't have the collection from customers. It's not visible from the revenue in the operating cash flow because it's not already paid. Change in receivable. It's not visible in the expenses, but you spend some cash for the inventories. So it's in your operating cash flow, the change in inventories, but it's not already in the expenses. For the finished good inventory, for instance. Or it's visible in your expense, you are using some raw material, but you don't pay the raw material because you are taking the raw material from your inventories. So it was already paid during the previous period, and so on. So we say the 2 classical steps, step 1, step 2, but we have also other things. Here they decided to eliminate the interest expense. So they add back some cash expense. You have to pay the interest, it's a cash expense, but they add back some cash expense and they replace by the interest paid. So here it's in order to show some direct, it's like the direct methods, they put directly the cash impact. So it's interesting because you have information about interest expense and you can compare with the information about interest paid. And here is not classical. The interest paid is quite the double of the interest expense. Normally, we have more interest expense than interest paid because in the interest expense, we can include non-cash expense. So what we name interest and other financial expense can include the interest expense, but also you can have some depreciation, some impairment on financial assets, some gain on financial assets. So you can have other things inside. No, it's interest expense, so it's not gain. Here for the interest expense, you can have the interest expense, interest due, but you can have other impact with a non-cash effect. Like some depreciation, no, not on this side. On the other side, if you talk about interest income, for instance, for the interest income and other financial income, you can have, for instance, depreciation, which is not paid. So here we have the double. So I come back to CAUT, and I think I have a question about it. So here about accounts receivable. In the accounts receivable, I show you accounts receivable. You have the accounts receivable. Do we have an increase or a decrease? So here the question is, we consider here an increase. Do we have an increase, true or false? True in red, false in blue. Do we have an increase in receivables? Only two answers. It was too fast, maybe. So here, in the receivables, I have a positive number. Okay. Negative between parentheses, positive, no parentheses. So it means it's plus this one. So here we have the 14 plus this one, minus, plus, minus, 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 and we finish with this one. Okay. So here we have a positive impact of the change in receivable in terms of cash flows. So in 2019, here we have a kind of cash inflow. So we start from the revenue, and in order to have the receipts, we add this change in receivables. So if the receipts is higher than the revenue, it's because in reality we have a decrease. So the cash inflow, it's a decrease in accounts receivable. So generally in the statement of cash flows, we want to show directly the cash impact. And if we are decreasing some operating assets, now you are supposed to have the cash. So it's a kind of cash inflow. If you increase your operating assets, you are supposed to consume the cash. So you reduce your cash flow. It's a kind of cash outflow. But the problem in this presentation, you are not sure it's a real cash inflow. Do we have more cash thanks to the customers because we reduce the receivables? Because we have two possibilities for the receivables. We can have the cash effect. We collect the cash from the customers. Or we can have some problem to collect the cash and we reduce the receivable because of the bad debt expense. We expect to collect less from the customers. So we increase the allowance for doubtful accounts. Okay, with the bad debt expense, you increase in your balance sheet the allowance for doubtful accounts. So you have two possibilities. One is a cash effect, and it's a good thing. The customers are paying, and you reduce the receivable because you collect the cash, or you expect to receive less in the future. You change your forecast about what you will collect, and you have to consider a reduction in the net value of the receivables. So it's important to understand why we have a change in accounts receivable. So the accounts receivable in the balance sheet are here in the short term. You have also receivables from the long term. And why do we reduce the receivables? We have to go to the notes in order to understand why we have the change. And don't forget, you can have a change because of the expectation about what you will collect. So you have the allowance for the full accounts or for the full debts they put here. And in your P&L, it's what we name bad debt expense. So we have explanation about the change in the allowance for the full accounts. We have an increase. So here it's a very bad thing. We expect to collect less in the future. So we change the estimate of what we will collect. We can have allowance used during the period. It means is repaid by the customers what is due, but not totally what is due. So for instance, what is due is 100 and you forecast 10 is not repaid. So you expect to collect only 90. So this is the gross value of the account receivable. This is the allowance for the full accounts or the full debts. And this is the net value. And finally, you collect the 90. So the cash inflow is 90. So you have to eliminate this one, the 90. But in reality, in your T account, you don't have the net value. So if you want to eliminate the 100, the 90, in reality, what you have to eliminate is the 100 and the minus 10. So you eliminate the minus 10 with this one, and you eliminate the 100 with the change in account receivable at gross value. And you can change the estimate of what you will collect. You write back what you expect to collect. So here it's a good news, you collect more than expected. So too much allowance for the full account, you reduce the allowance for the full account for some customers. But in reality, you increase more than you decrease during the period. So the balance is not very good. So the problem with the statement of cash flows, it's in the step number one. In the step number one, generally, we don't put the bad debt expense. We don't put the write down of inventories. Which are non-cash expense. If we don't see this one and this one, it means we have the change in receivable at net value. We have the change in inventories at net value. The problem with the change in receivable at net value and the change in inventories at net value, it's you don't have only the cash impact. For all the two, you can have some cash impact. If you reduce your inventories because you sell it, you have a cash impact. If you reduce the receivable because you collect the cash from the customers, you have a cash impact. But you can have also a change in estimate about what you will collect. You expect to collect less from the customers. You reduce the receivable at net value because of the increase in allowance in the full debt. You reduce the selling price because of this. You reduce the value of the inventory because you expect to receive less when you will sell it. So the problem is you have the cash impact, but you have also the impact of estimates about what you will collect in the future. So it's totally different. And you have the two together because we don't have this line item in the step number one. We don't eliminate this one. In this case, it's together in the step number two. If we have in the step number one the bad debt expense and the write down of inventories, in this case, it's different. We have only the cash impact in the step number two. If we have this, the number 1. In this case, you have only the number 2 in the step number 2. So we'll come back on it later. We'll do the calculation. Another question. So you have 20 seconds to answer to the question. Be ready. It's about the interest expense and interest paid. We saw the interest paid is the double of the interest expense. Next question. So true or false? So sorry, is in French. Blue, true. Red, false. Only 5. So we can have some interest capitalized. It's possible you don't see the interest in the interest expense. This is a situation for Vinamilk, for instance, because of the debt in order to construct new assets. If you borrow for the construction, you have the possibility to include the interest expense as a part of the property, plant, and equipment. You capitalize the interest. In this case, the interest paid is no more visible in your financing cash flow. It's included in your investing cash flow as a part of the net capex. And you don't see the interest expense in your P&L. It's a part of the depreciation expense in your income statement. Sorry. So, in reality, the capitalized interest are not visible in your interest expense, and they are not visible in your interest paid in the financing cash flows. So it's not the reason of the difference between the interest expense and the interest paid. So if here we have a difference between the two, between the interest expense and the interest paid, the explanation is not in the capitalized interest, because the capitalized interest are in the depreciation amortization, and the interest paid related to the capitalized interest are in the capex, in the investing cash flows. So the answer is no, we don't explain the difference because of the capitalized interest. So in this case, we have here the interest paid because of the interest capitalized. So now we can separate in the investing activity what is related to the next capex, what is related to the business combination, and what is related to the financial assets. Sorry. So in the investing activities, it's interesting to separate 3 parts. So we want in this one the net capex, investments minus investments, the business combination, in order to separate the recurring free cash flow from the total free cash flow, and the financial assets, the change in financial assets. Because it's totally different, the decisions about the financial assets and the decisions of purchasing some buildings, cars, trucks, and so on, because of the operating activities. So where is the net capex? Is here. So here we have the net capex with the investments and the divestment. Investment and divestment. And after all the rest is related to net cash flow from business acquisition. So here we have the business combination. And here all the rest is related to the financial assets. So when we want to calculate the free cash flow, we use the net capex, we can use the business combination, but we don't use the financial assets. In the financing activity, it's interesting to separate the equity financing with the change in equity, with the cash effect, equity financing, from the debt financing. And this one is a part of equity financing, the debt financing. And generally, it's interesting to check the net amount, new debt minus the repayment of the debt. So here is positive the amount. It means Vinamilk has more new debt than repayment of the debt, which is totally, which is different in the previous year. In the previous year, it was quite the same. So generally, we want the net effect. For instance, here we have the increase in equity higher than the, no, it's very low. We have more payment of dividends than increase in equity. So we have a negative equity financing. So first, when we analyze the statement of cash flows, we want the big categories. The big categories are here. With indirect methods, we want the net profit. We want to understand what are the non-cash expense, non-cash revenue. Here is related to what we name earnings management. Or quality of earnings. So in this part, we want to understand if the company is trying to increase artificially the net profit by using one-time revenue to creating one-time expenses. We can eliminate the next time. So it's about the question of how the earnings are managed by the CEO and the CFO. So in this part, we check carefully if we are not trying to increase or decrease the net profit because of strange decisions and one-time decisions, just in order to manipulate the net profit for this part, this time. So for instance, in the step number 1, we have the change of the CEO. At the moment of the change of CEO, so we have a new CEO in 2020, and we have the previous CEO before 2020. So when you come in the company as the new CEO, you know that your performance will be estimated with your capacity to increase many key performance indicators. Do you have the capacity to increase the net profit year after year? So for the year 2020, if you are new, you will say the performance in 2020 is because of the previous CEO. The effect of the new CEO is expected only in 2021. So what you want to create for 2020, it's a reduction in the net profit. You want to reduce the net profit in order to say we had a bad performance because of the previous CEO. And thanks to the decrease, you expect to increase during the next year, 2021. You can show an increase. So what you need in 2020 is one-time expense, only for 2020. In this way, you can show an increase for your first year, first full year in the company. So generally what you do is to create a lot of impairment losses. Because of the acquisition of the past CEO, we paid too much the previous acquisition. So we need impairment losses in order to reduce the value of the acquisition. So with the impairment losses, we explain the discounted cash flow expected from the business acquisition in the past are lower than the net book value of the acquisition. So the net realizable value is lower than the net book value. So we need to decrease the value of the assets. So we use this one and what we name in the IFRS value in use. And you see, in reality, the performance is not very good because finally in 2021, the performance is no more than the performance in 2019. But the new CEO will consider my performance is compared with the previous one. So I want to reduce this one in order to have easily a good performance in 2021. So with the change in CEO, it's classical to have a lot of impairment losses in this part, for instance. And it's generally a one-time expense, so we are sure we will not have this during the next year. In the step number 2, we want to see how we manage the operating assets and the operating liabilities. If the net profit it's with an increase in the sales revenue, we increase the sales revenue and we are creating this net profit. Normally, generally you increase your operating assets and you increase your operating liabilities. Sometimes it's the reverse, but normally you have the same direction for the operating assets and operating liabilities. So what is interesting in the second step is to see the direction. Do we have at the same time an increase in operating assets and operating liabilities, or do we have at the same time a decrease in operating assets, a decrease in operating liabilities? If we don't have the same direction for the operating assets and operating liabilities, it can be a problem. Maybe artificially you are trying to create a huge operating cash flow because you need to repay the debt. So you need a huge operating cash flow in order to pay the debt, and you don't have the cash naturally from the net profit. After the step 1, you have a small cash. So for instance, you have 20 in the net profit. Thanks to the step 1, you increase by 80. So now you have 100. And the repayment of the debt is 200. So minus 200 in terms of cash. And you need the 200 in order to pay the debt. So you need, with the step number 2, to increase by 100 in order to finish with the 200 and to have the capacity to pay the debt with your operating cash flow. So what you want in the step number 2 is plus 100 because it's not enough with the step number 1. So what you can do is to reduce your operating assets in order to create a cash inflow, to increase your operating liabilities in order to create a cash inflow. But you are doing that just because of the problem of the debt. So maybe you are reducing the inventories and you finish without inventories. So it's a problem for the next period. You have nothing to sell for the next period. Maybe you are increasing your operating liabilities, but with a negotiation with the suppliers, and you will pay more in the future because you don't pay anymore after 60 days, but now you pay only after 90 days. If you negotiate this with the suppliers, maybe you will have to pay more for what you purchase because now it's 90 days and no more 60 days. So it's a bad decision generally for the companies, and it's visible in the statement of cash flow when you don't have the same direction for the change in operating assets and the change in operating liabilities. If you have a different direction for the two, you can try to understand why we don't have the same direction. We should have the same direction because the operating assets and the operating liabilities are related to your sales revenue and your operating expenses. So if you increase the sales revenue and the operating expenses, normally you increase your operating assets, you increase your operating liabilities. So in the operating cash flow, it's interesting to have these 4 subcategories. In the investing cash flows, it's interesting to have 3 subcategories. In the financing cash flows, it's interesting to have 2 subcategories. So this is the macro level. Before going to the details, first what we know is to understand the big categories in order to analyze if we have a normal performance or if we are trying to increase the performance with some artificial decisions, with some one-time decisions, with an effect only for 1 year, but not for several years, and so on. Now we can separate the recurring free cash flow. The recurring free cash flow is here, after the capex or net capex, in order to say investments minus investments. We can have a more general free cash flow with also the decision to purchase some new activities, new companies. In function of the free cash flow, do we have a positive free cash flow or a negative free cash flow? In function of this, we'll take the decision for the rest. The decision for the rest is in function of the sign of the free cash flow. If it's positive, we can decide to increase investments in financial assets. We can decide to decrease the equity financing. To decrease the financial liabilities financing, it means you have more repayments than new debt. Equity financing, you decide to distribute some dividends. You decide to repurchase your own shares. And at the end, you can decide to increase your cash. So this is the situation with a positive free cash flow. If we have a negative free cash flow, it's totally the reverse. You are selling some financial assets, you are increasing your equity financing, you are increasing your financial liabilities financing, you are decreasing your cash. So for the managerial decisions, we don't want exactly the statement of cash flow in 3 parts. What we prefer is the cash flows with 2 parts, the calculation of the free cash flow, and after the use of the financing of the free cash flow. Do you want to take the break now? And we continue after? False. What is false? False, the answers. Yes, false. So do we take a break now? Generally, when do you take the break? Now? Okay. 10 minutes, it's okay? 10 minutes break? Okay, see you in 10 minutes. So keep Kahoot open. We continue with Kahoot after the break and with the PowerPoint, okay? See you in 10 minutes. So maybe I stop the video now and I start again after. or we let this 10 minutes? Maybe I can stop the video. Yes. So we continue the session about the statement of cash flows. So we said before the break, before going to the details of what is included in the operating cash flow, investing cash flows, and financing cash flows, it's interesting to separate these subcategories in order to analyze the free cash flow, and also in order to separate the financing from the shareholders, or the financing from the debt from the bank, or from the issuance of bonds. So all these subcategories are interesting to analyze later. So again, for Vingroup, for instance, we have the two parts, step 1 and step 2. And again, we eliminate interest expense in order to show the interest paid. We eliminate is before tax, so we don't have the income tax expense in order to show the income tax paid. The interest paid and the income tax paid, I suppose, is compulsory to show it under Vietnamese GAAP. It's compulsory to show it also under IFRS. So because we want to see the interest paid and the income tax paid, we need first to eliminate the interest expense, or we start from the profit before tax in order to avoid to include the income tax expense. Here is more. Here we have more interest paid than we have less interest paid than interest expense, or quite the same. So it's it's a normal situation with something very close for the interest expense and the interest paid. And again, receivable, it's in the operating assets. When you increase, it's a negative amount. Inventories, it's in the operating assets. When you increase, is negative amount. Payables, accounts payable, it's in your operating liabilities. When you increase, it's a positive amount. Prepaid expenses, it's in the assets. When you increase, it's negative amount. Held for trading securities, it's in the assets. So when you increase, is negative. So when you increase some assets, it's a kind of cash outflow. When you increase some liabilities, it's a kind of cash inflow. Okay. Again, in the investing activities, we can separate what is from net capex from the financial assets. From the business acquisition. And here you can see some interest and dividends received in the investing cash flows. So I come back to Kahoot. Next question, it's about the interest and dividends received. So true, false. Can we have the receipts of interest and dividends in the investing cash flows? True or false? No, it's I made a mistake. It's false. false. Sorry, good answer is false, not true. Under IFRS, we will see that later, or maybe I can show the slide about this. Why is the difference between IFRS and US GAAP is here. Under US GAAP, what is related to the P&L is in the operating cash flows. So dividends received is related to the financial profit, interest, and other financial income. E is related to the income tax expense. E is related to the interest income. E is related to the interest expense. So when it's related to some lines in your P&L, under US GAAP, it's compulsory to put in the operating cash flows. Under IFRS, you have the choice. The interest paid can be in the operating cash flows or the financing cash flows. The interest received can be in the operating cash flows or investing cash flows. So investing, like here in Vingroup or Vinamilk. For the interest paid, it's more in the operating. For the dividends paid, you have the choice under IFRS, operating or financing. In Vinamilk or Vingroup, you can see in the financing. In US GAAP, it's financing also. For the dividends received, it can be operating or investing. Vinamilk or Vingroup, it was investing. Income tax expense, all in the operating, or you separate in function of the different activities and the impact on the income tax and your operating. So under IFRS, the dividends received and the interest received must be in the operating activities. So it's not possible to include this one in the investing cash flows. So the problem is the comparison of the free cash flow. For the free cash flow, if you say free cash flow is equal to operating cash flow minus the net capex, under US GAAP, you will have in this one the interest and dividends received. For Vinamilk or Vingroup, we have no interest and dividends received here. So it's not included in the operating cash flows. So when you compare the performance, you have to be sure you include the same thing. Under US GAAP, you have the interest and dividends received in the operating cash flow. If you want to compare the performance of these Vietnamese groups with some American groups, you have to include the interest and dividends. Here, they are in the investing cash flows. So in your investing cash flows, you have to take the interest and dividends received in the calculation of the free cash flow in order to have something comparable with the performance of the American companies, if your purpose is to compare the performance. So under US GAAP, you have no choice. Under IFRS, you have many possibilities. When you have many possibilities, the problem is in the comparison of the performance, you have to be sure you have the same choice for the different companies. If you don't take the same choice, it's not comparable. I come back to this one. So here in the calculation of the free cash flow, we should include this one if we compare with companies in which is already included. And after we have the equity financing and the debt financing, and the dividends can be in the equity financing. So here is for Samsung. the calculation of the operating cash flow. They start from the profit for the year, the net profit. So because they start with the net profit, they need to eliminate the income tax expense if they want to show the income tax paid. So in the adjustments we have here, we have plus income tax expense. So you have two possibilities. You want just the difference between income tax expense and income tax paid. So the change in tax liabilities and tax assets, or you eliminate the income tax expense in order to replace it by the income tax paid. So two possibilities. We start from the net profit, and now we want the operating cash flow. First possibility is to eliminate the income tax expense, what is already included in the net profit, and we replace by the income tax paid. The other possibility is to say in the step number 2, we want the change in tax assets and tax liabilities. And we need also the change in deferred tax. Change in deferred tax. Assets and liabilities. So in this case, you have directly the difference between the income tax paid. So here you have directly is equivalent to minus income tax paid plus income tax expense. With the two lines, you have this difference. In order to transform what is income tax expense here into what is income tax paid here. It was minus in this one and minus in this one. Okay. So all the time you have two possibilities. You want just the difference to explain the difference between the cash expense and the disbursements. You take the change in some assets and liabilities, or you eliminate the expense in order to replace it by the disbursement. Generally, we have the situation on the left because it's compulsory to show the income tax paid. So because we have the interest received, interest paid, dividends received, and income tax paid, it means here we need to eliminate the interest income, the interest expense, and the income tax expense. So we need to eliminate all the financial profit, all the income tax expense in order to replace it directly by the disbursements and the receipts. So where is the net capex here? It's financial, so we don't care. Financial again, financial. What is financial is not included normally in the net capex. And now we have investment in associates. So here we have business acquisition. Increase in the here it's investment in associates. It means we have between 20 and 50%. So we have less than 50% and more than 20%. So it's again financial assets. Sorry, all this is financial assets. So here it's about the financial assets. Here we have the net capex. And again, we have business combination. many lines for all the financial assets here. Financing activity, again, we have debt financing, including this one, sorry. And we have equity financing. Generally, in the statement of cash flow, what we want is the net value differences between inflows and outflows, cash inflows and cash outflows. So for instance, the net capex, it can be investments minus investments. Sometimes we use this name for minus also D&A expense. It's in the Damodaran books. It's a professor from New York University. He is also minus D&A expense. We will see later why we have this. The operating working capital or working capital requirement is a net value also. Operating assets minus operating liabilities, so minus. For the financial liabilities, we want to know if we increase or decrease the debt. So it's again a difference between the increase of the debt and the repayment of the debt. For the financial assets, do we increase or decrease the financial assets? It's an acquisition minus the sale. So generally, all the time, we are interested by some net values, differences between acquisition and sale. So in the Damodaran book, we have a different net capex is here with minus the D&A. Normally, what we have, it's in the step 1, we eliminate the non-cash expense. And after, for the calculation of the free cash flow, we need the net capex, which is here. The traditional net capex is more this one. Investments minus investments. Why is interesting the presentation on the right side is because here is directly, you can directly answer to the question, do we increase or not the capacities? The manufacturing capacities and commercial capacities. Do we increase the manufacturing and commercial capacities? Here, it's about the evolution of the property, plant, and equipment and intangible assets at net value. Why do you modify the net value? You modify the net value because of the acquisition and the sale. So because of the acquisition, you change the gross value. Because of the sale, you change the gross value and the net value. And also because of the reduction in value of what you own. So, for instance, the depreciation amortization expense. So with this calculation of the net capex on the right side, you have directly an estimation of the change in property, plant, equipment, and intangible assets at net value. And with the net value, we are supposed to be to have an indicator of the manufacturing company and the commercial capacities. So if this one is higher than 0, we suppose we are increasing the capacities of the company. We expect to sell more, to produce more in the future. If the net capex is lower than 0, we are decreasing the capacities, manufacturing and commercial capacities of the company. So if we separate the two, it's interesting to compare the two. Do we have a net capex higher than the D&A expense? On the left side. Again, about the net value. For the equity financing, do we have a positive or negative equity financing? Do we issue more shares or less shares than we repurchase our own shares? It can be also minus after the dividends. So we have different calculation of the equity financing. Equity financing is more generally this one. This is a young company, Amazon, in 1995, 1996, 1997. The company was created in 1994. Here we can see we have a mistake. Normally all these are more here. Okay. You have to move the line for the year 1997. 1997 is the year of the initial public offering in 1997. The introduction on the financial market. So for this company, we can see, I erase all this. We can see we increase the loss. So here it's in thousands. So we finish in 1997 with 27 million of loss in the bottom line of the P&L. What is interesting, it's now we have a positive operating cash flow. So they increase the loss, is more negative year after year, but they increase the operating cash flow and they finish with something highly positive. How is it possible? It's because of the accounts payable. You can see the accounts payable is a huge increase in accounts payable, and it's a positive number. It means they are increasing the accounts payable more than they increase the inventories, more than they increase the prepaid expense. So the problem of Amazon is how to finance the inventories. And in reality, the inventories are financed by the suppliers. Here you have the suppliers. Thanks to the suppliers, the inventories are financed. And more than just inventories, they can finance also a part of the loss. So because of the negotiation with the editors, they have the possibility to pay later the books they purchase. And thanks to these contracts, commercial contract with the suppliers, they have the financing of the inventories. So they have inventories, but they pay later for the inventories after they sell it. So in the operating cash flow, we will use the subcategories. We start with a loss. After the step one, they continue to have something negative. So the potential operating cash flow is negative. The capacity to create a positive operating cash flow is not here in 1987. But thanks to the decrease in operating working capital, they finish with something positive. So here, they have a negative operating working capital. It means operating working capital is current operating assets minus current operating liabilities. They have more operating liabilities than operating assets. So they have more financing from the suppliers, from the states, the employees, and so on, than what they need to finance the inventories, the accounts receivable, and prepaid expenses. So it's negative. So when they increase the sales revenue, they increase the negative operating working capital, which is the financing. So generally, we're interested by one ratio, operating working capital in percentage of the revenue. For this company is lower than 0. So when they increase the revenue by 10%, for instance, they decrease the operating working capital. So maybe they decrease by 8%. So when they decrease, it's a source of cash. So a negative operating working capital less than 0, it's a source of financing. A positive operating working capital or working capital requirement, it's something you need to finance in the short term. So the success in terms of cash of this company is the capacity to negotiate with the suppliers, huge credit terms, in order to finance, to have the inventories financed by the suppliers. And a part of the loss is also financed by the suppliers. It's interesting, we say, to compare the investments minus the investments with the D&A expense. So it's more than 2 times the D&A expense, 4 times here, 2.7 times. So it means they invest much more than the reduction in value of what they already own. So they are increasing in a huge proportion the productive capacities, manufacturing capacities. The operating cash flow is lower than the net capex, but don't forget the net capex is only this one. Here is financial assets. Investments here means financial assets. So you have two meanings for investments. Sometimes it means financial assets. Sometimes it means you are increasing some non-current assets. So here it means financial assets. So why we have all these financial assets? Why they decided to purchase all these financial assets is because of the initial public offering. Don't forget we are in 2017 here. It's huge. They decided to have new debts. They don't need all this cash for the free cash flow. The free cash flow, it's minus 3.7 million. So it's too much by comparison with the 3.7 million. So they decided to purchase some financial assets in order to have some interest income thanks to that and to use the cash later. So here we have the calculation of the free cash flow, and now we can use the rest of the statement of cash flows in order to have the financing of this free cash flow. How do they finance the 3.7 million they need because the free cash flow is negative? So we take the rest. So they have some equity financing with the introduction to the financial market. They decided to purchase some financial assets. So the difference here between purchases and the sale, net amount. So the net investment in financial assets is negative. They use the cash for that. They decided to have a new debt. They decided to increase the cash. So this is the use of the cash. So minus. So now we add all this. We have the explanation of the financing of the free cash flow. It's the same in 1986, 1985. So you see, we can transform the statement of cash flows with three categories into two categories: the creation of the free cash flow and the financing of the free cash flow when it's negative, or the use of the free cash flow when it's positive. So here is negative all the time. So we have the financing of the free cash flow. So they used a lot of the equity financing, but also the debt financing. So we saw the differences between IFRS and US GAAP, and with what we can see in Vietnam. So for the IFRS, you have to go to the IAS 7 if you want some explanation about what you have to do for the statement of cash flows. So this is the name of the IAS. International Accounting Standard is the number 7 about the statement of cash flow. And it must be visible, the interest paid, the dividends paid, income tax paid. So if it's not directly visible in the statement of cash flows, below the statement of cash flow, you have to show these three values. Explanation. You can read later, or you can go directly to the IAS 7 if you're interested by what is possible to do under IFRS. So now we'll see how to calculate the operating cash flow. So we said we have two different presentations. We can have the direct methods with the receipts minus the disbursements, or we can have the indirect methods. In the direct methods, you can put directly receipts minus payments, or you can start from the P&L and you explain why is different the cash inflow. For instance, you start from the revenue, you explain that you have minus the increase in accounts receivable, and plus the increase in unearned or deferred revenue. And now we have the collection from customers. So we explain from the revenue and expenses, and the change is more this one, semi-direct methods. In the indirect methods, 2 steps. We eliminate the non-cash expense, non-cash revenue, and in the second step, we have the change in operating assets, operating liabilities. We eliminate also the gain and losses. What is the gain and losses when you are selling some non-current assets? So when you sell some non-current assets, so for instance, in your equity, the non-current assets is the property, plant, and equipment at net value equal to 100, and you sell it, the sell price, at 120, okay? So what you need to do is to eliminate the property, plant, equipment, because you don't own it anymore. So in your other side, you have the equity. You have the impact of the profit in your equity. So you eliminate this one, minus 100. In reality, what you do, you eliminate the gross value and you eliminate the accumulated depreciation. At the end, what you eliminate is the net value. So minus 100 here, and in your profit, minus 100. In your current assets, if it's cash paid, you modify the cash. In the other case, you modify some accounts receivable. So you suppose you receive the sale price, it's cash paid, so plus 120. And you need to keep the balance sheet balanced. So in your profit, you put plus 120. So we have the same reduction in assets, minus 100, than the reduction in equity, minus 100, and the same increase in assets, plus 120, than the increase in equity, plus 120. So the total effect on the assets is plus 20. The total effect on the equity and liabilities is plus 20. The plus 20 is a gain. So here is positive, so it's a gain. So we need this gain in order to compensate the sale in the assets of the property, plant, equipment and the increase in cash. Why we eliminate the two? The plus 120. It's cash revenue. We will collect it. So normally we don't have to eliminate this one, but we eliminate this one. Why? Is because this one is in the investing activity. And we are calculating the operating cash flow. Okay, we start from the net profit and we want to finish with the operating cash flow. We are in the first part of the statement of cash flow. So we need to eliminate the gain and the loss. So we eliminate the 120 because it's too soon. It's not in the operating cash flow, we want this one. It's in the investing cash flow. So we eliminate the sale price. And the minus 100, because we eliminate the property, plant, equipment, it's a non-cash expense. We don't pay for that. It's because we don't own it anymore. We need to eliminate from the assets. So we put minus 100 to eliminate the property, plant, equipment. It's a non-cash expense. We put plus 120, but it's investing activity. So what we need to eliminate is directly all the gain, the 20. So in the step number 1, all the time, you will have minus the gain plus the loss. So if we start from the P&L, you have to check in your operating assets, operating liabilities. Do we have a change? We have some sales revenue, but at the same time, we increase the account receivable, so minus the increase. We have some advances received from customers, some unearned revenue, So plus the increase, and now we have the collection from customers. For the interest income is what is due to the company, but maybe one part of the interest will be paid later, so minus the increase in accrued interest receivable. And maybe you receive some interest in advance, so you have some earned interest in the operating liabilities. So now you have the interest received. For the cost of merchandise sold is the outflow from the merchandise inventory. If you increase your inventory, so here it's minus is a cost, minus cost of merchandise sold in your P&L. So this one is plus, plus, minus, minus the rent expense, minus all this. Okay, we have the sign minus before. So we have minus the cost of merchandise sold. We have to come back to the inflow in the inventories. If we want to come back to the inflow, we have to add the increase in inventory, so minus because it's already minus. If we pay in advance, we have also what we paid in with a minus. And if we pay later, we have plus the increase in accounts payable. So when you have the cost of merchandise sold, here in the merchandise inventory, the outflow is the cost of merchandise sold. And what you want to find is the inflow, the merchandise purchase. You have the opening inventory, the ending inventory. So how do you find the number 1 from the number 4? You need the number 3 and the number 2. So the number 1 is equal to the number 4 plus the number 3 minus the number 2. So you have the outflow plus increase or minus decrease in merchandise inventory. So the inflow is equal to the outflow plus increase minus decrease in merchandise inventory. And from the purchase, what you need is the payment to suppliers of merchandise. We want the cash outflow. Payment to suppliers of merchandise. So you have two possibilities, is paid or is paid later. So you are increasing the accounts payable, or is paid in advance, another situation. So you can calculate this one in function of the change in accounts payable and in function of the advance to suppliers of merchandise. So it is why we have all this here. If we start from the cost of merchandise sold and we want to finish to the payment of supplier of some merchandise, we need all this part. So we start with some negative amount, is expense. We add the increase in negative amount, increase in negative amount, and when increase this one is then positive, and we finish with some negative payment. So all the time for each line item in your P&L, you check in the operating assets and operating liabilities in your balance sheet if you have some change. It's the step number 2. In the step number 1, we already eliminated in the income statement the D&A expense, the impairment losses, and so on. So with the direct methods, you can see the receipts, the payments is direct. But generally, with the direct methods, we don't give a lot of information. We have the payment to suppliers and employees, and in the note, they separate suppliers and employees. but we don't have a lot of line items. What is interesting with this Australian company, we have also the indirect methods in the notes. So again, we have the step number 1 with the non-cash item and the step number 2 with the change in assets and liabilities, but in reality it's operating assets, operating liabilities. And at the end, of course, we finish with the same values. Sorry, and this one. Same values here. So what we name operating activity is not exactly the same in the P&L. Operating activity is normally sales minus operating expenses. In Vietnam is different. What you name net operating profit in Vietnam is two things. The operating profit under IFRS or US GAAP with this one and this one, but you include also the financial profit. So in Vietnam, the net operating profit is not exactly only the operating activity. Operating activities create in the balance sheet some operating assets and operating liabilities. So it's visible in your balance sheet with current and non-current operating assets and operating liabilities. We can include also the property, plant, equipment, and intangible assets. Operating activities in the statement of cash flow is very different. Here is all the cash impact of the P&L, generally. In Vietnam, whereas we saw for Vinamilk and Vingroup, it's a little different because you don't include the interest received and dividend received, which is in the investing cash flow. So it's without the impact of the interest income. In the step number 2, when we increase the operating assets, it's a kind of cash outflow. When we increase the operating liabilities, it's the reverse. Okay, and we can see it with the equation change in assets equal change in liabilities plus change in equity. Here we want the cash. We start from the profit. So the change in cash is equal to the profit on the other side, plus the change in liabilities, but minus the change in assets. We put on the other side the rest, operating assets. So is why is different the effect. The pure indirect methods is step number 1, we say we eliminate the non-cash expense and revenue. Step number 2, we have the cash effect of operating working capital. But in reality, we have more this presentation. We eliminate the non-cash expense and revenue, but we add back also some cash expense and revenue, like interest income, interest expense, income tax expense, in order to replace it directly by what we pay, interest received or what we receive, interest paid, income tax paid. So we have this step because we want this one, okay? So because we want the step 3, we need the step 2 because we start from the net profit. If you start from the profit before tax, you don't need the income tax expense. If you start from the EBIT, earnings before interest and taxes, you don't need this one, this one. So if you start from the EBIT, you don't need the step number 2. It depends what is your starting point. Is it the net profit, the profit before tax, the EBIT, the EBITDA, and so on? You have the choice, generally, about the starting point. So one exercise in Excel. So now what I propose is to go to Excel. So if you go to the modules, in the session 1, you have the example of the indirect methods. So download the template and try to complete the template. So indirect methods template. You have this one. And you try to find the operating cash flow with the pure indirect methods and the other permutation. We will finish with the same operating cash flow at the end. So in the step 1, you eliminate some line items in your P&L. In the step 2, you go to the balance sheet and you check the change. In the pure indirect methods, we put all the non-cash items in the first step. So in the step number 2 is directly about the gross value. So here at gross value. In the second presentation, we use a net value. So in the step number 1, we don't eliminate the bad debt expense or the write-down of inventories. In the step number 2, we want to show the interest received, the interest paid, the income tax paid. So we first eliminate the interest income, the interest expense, and the income tax expense. So I let you 10 minutes to do the calculation, and we do the correction. So here we have a P&L with operating expenses by function. I do the correction in 3 minutes. It's already done, the calculation with the two methods. And at the end, you have the same operating cash flow. So in 1 minute, I do the correction. Did you find the same operating cash flow with the two methods? I do the correction. Yes, no. Okay, do the correction. So in the first presentation on the left, the idea is to eliminate all the non-cash expense. So here we eliminate the D&A expense, depreciation, amortization, impairment losses, write-down inventories, bad debt expense. So all this is without a cash impact. So we start from the net profit, the bottom line. We eliminate the D&A expense, so we do the reverse. The D&A expense are in two parts, the cost of goods sold and the SG&A expense. So we eliminate all this. In reality, maybe I will modify. We have impairment losses, D&A expense also in the gross value. So normally we should also eliminate, we'll create a different version, the depreciation and amortization included here. So here, including depreciation and amortization expense. So in the inventories, we have a part of the depreciation and amortization expense of the period. For instance, here we have 120,000 or 90,000, and here 140,000. Normally, what you eliminate is the D&A expense invisible in your P&L, but it's only for the period, plus what is included in your inventories. So the difference between the new one and the previous one. So it's a different version. I consider also depreciation amortization included in the inventories. It's not exactly the correction of this. I modify this. I put some depreciation amortization in the inventories. Because we use the full costing methods. We have also D&A inside the inventories. So I take all the D&A expense for the period. Not only what is visible in the P&L, okay? Impairment losses. I eliminate the impairment losses. They are here after the operating profit. It's in the non-recurring expense. So here in the first part of the P&L, we have the operating activity. Here we have the non-recurring expense and income. So in this part, we can have a restructuring cost, impairment losses, gain and losses on sale of assets. Okay. And after we have the financial profit. Financial profit. Okay. And with the three of the financial activity, I say activity, financial activity, non-recurring activity. And with the three activities and the three profits, you have the profit before tax. The write-down of so I eliminate the write-down of inventories and the reduction of value without a cash effect. So minus 230. I eliminate the bad debt expense. It's estimation of what I will collect from the customers in the next period. I eliminate. I have some reversal. Here, I eliminate. For the provision, I want the provisions visible in the P&L. So minus this one and this one. The new provisions, inflow. So now I can calculate the potential operating cash flow. After the step one, I finish with 2,595,000. Now I want the cash, I can separate the cash effect of the change in operating assets and the change in operating liabilities. I can take directly the account receivable at gross value because I have already the bad debt expense on the reversal of bad debt expense in the first step. So I don't need to take the net value, I can take only the gross value. If I increase the account receivable, it's a cash outflow. So I do opening minus ending. An increase, I want a negative amount. It means I don't collect this from the revenue. The inventories is the same. I will do opening minus ending, and I want the gross value. Opening minus ending. Accrued interest receivable, it means I should collect some interest, but maybe I will receive the interest later. So I'm creating some accrued interest receivable. So when I increase is negative also. So I do opening minus ending. Here it's a part of the assets. So when I have assets, I do opening minus ending. Now I'm in the liabilities. So now I do ending minus opening. If I increase, I save the cash. It's a kind of cash inflow. So in the accounts payable, I take ending minus opening. Line 16, check. Yes. For the accrued interest payable is the same. Interest due but not already paid. Ending minus opening. Ending minus opening. Now here I decided to separate the provision paid from the new provisions. So what I want is the outflow, what is paid. So here I use I have the change in provisions when I do this one minus this one. So I have 600,000, but I have 600,000 with an increase in provision by 420 and 270. So I want the rest. So I eliminate from this. So here is directly the difference. So maybe I can create here in the provision. The provision. We have the opening balance. I have the inflow. The provision expense. And I have the outflow. Provision paid or excess of provision possibility, and I have the ending balance. So here I will put the same size for each column. So the opening balance, it's here. The ending balance, it's here. And now the increase. So in minus because it's expense. So I increase because of this and because of this. So by difference, I can find this one. So the outflow is equal to the opening plus the increase minus the ending. 140,000. And I suppose here it's only provision paid. Because I don't see in the P&L some reversal of provision. So I suppose it's only provision paid. Provision paid in minus the tax payable again. I take ending minus opening. If I increase the tax payable, it's because I don't pay, and now I do the sum from here to here. 1.2 million. Now I want to find the same with the classical presentation, is more like this one, without the potential operating cash flow visible. So generally we don't have this, okay? This one is the French presentation. We put something here. We name capacité d'autofinancement. So here we have the net profit. Here we have the D&A for the period is the same than here. Impairment losses is the same, no change. And now we want to eliminate the interest income, the interest expense, and income tax expense in order to replace it by the interest received, interest paid, income tax paid. So the interest income is the reverse minus into part interest and other financial income. I suppose I eliminate all this. Interest and other financial income. I eliminate the interest expense. I do the reverse minus. Eliminate the income tax expense. I do the reverse minus. So now I have a potential operating cash flow, but without the financial profit. Okay. And in reality, we don't eliminate the write down of inventories, the bad debt expense. Because we don't eliminate the write down of inventories and the bad debt expense, we take directly the net value here. So net, because it's not already eliminated the bad debt expense and the allowance for the free accounts. So here we want the change in accounts receivable, opening minus ending because it's in the assets. When we have an increase, it's negative. Inventories at net value, so it's not gross but net. Opening minus ending, so it's a mistake here, it's net value. For the accounts payable, ending minus opening, the difference here. Provision is directly the change. I don't care if it's paid or if it's a non-cash expense. I take directly the difference, ending minus opening. Now I can put the interest received. So the interest received, I take all the interest and financial income because I eliminated the two, but it's not exactly the same. Or I should eliminate only the interest. So maybe I will eliminate only the interest income here. Interest income, I eliminate only this one. Okay, 110. So now the interest received plus. So interest received is because of what is due, interest income, plus what is due at the beginning of the period, accrued interest receivable, minus what is not already paid at the end of the period. So here's the equation of the interest received. Interest received equals interest income plus opening accrued interest receivable minus ending accrued interest receivable. So it's what is due for the period plus what is already due from the previous period minus what is due and not already paid. So the interest paid is the same, but here it's in minus. It's already minus, so I can keep the minus. So interest paid is interest expense. I add what is due at the beginning, but it's in minus, so minus accrued interest payable at the beginning. And I eliminate what is not already paid at the end of the period. So plus. Income tax expense, so it's in minus, it's already in minus here. I add what is due at the beginning of the period, tax payable, and eliminate what is due and not already paid at the end of the period. Where in reality is tax payable and deferred tax. Okay. Liability and deferred tax. So now I add all from here. What is a mistake? It's oh, it's not the same. Made a mistake somewhere. Why is different? 180. I use directly. Interest received. I will increase in interest. Interest receivable increased by 32. I don't receive the 32 of the rest. So yes, it's okay. In accrued interest payable, I increase by 25, so I don't pay the 25. I reduce interest expense by 25, 245. Yes, okay. I have to check why I have a difference of 190. 190. It's a huge. 190. Impairment losses. 190. No, I have the 190 only. It's the same 20, 24, 20, 29. Yes, it's okay. So why is this 180? Because I have the correction also directly, and I check later why I made a mistake. So with the correction, so it was 250, but without considering DNA expense inside the inventories. So it's a previous version, 150 here, 1,250 in the two calculation. Okay, so we check later why I have this difference. 217, 16. Okay, check. Do you have questions about this exercise? And we stop here for today. I put the correction of this today. And tomorrow we continue with the statement of cash flows. We continue with other questions. So maybe for tomorrow, you can prepare the answers to the MCQ we finished today, which MCQ? MCQ number 4. So for tomorrow, you can try to do the MCQ number 5, 6, 7, 8, 9, 5 questions. For the question 6 and 9, you have the Excel file. So you can resolve on the Excel file. And we start tomorrow with the correction of these questions, okay? So from the question 5 to 9, in your PowerPoint, you should have the number of the questions. So we can see later you have the, no, you don't have the number. So here it was the question 5. So do the MCQ. When you see MCQ, just you have to do that. MCQ number 5, number 6, number 7, number 8, number, sorry, I show the answer, number 9. We finish with this one. Number 9. So I put the slide with the correction of what we did today. I put the Excel file of the correction of the calculation of the operating cash flow with the two different methods from the indirect methods. And for tomorrow, you do the question 5 to 9. So now we have the name. So you have to do these questions, okay? And we start with the correction of the 5 questions. I stop the recording. It's okay for everybody? other than the slide. Reading about the statement of cash flows. Yes, the chapter 4 and 5. I will put the PDF of the book. I have to find it in the previous year. Maybe I have the yes, this one, cash management textbook. So here you have the chapter 4 and 5 is useful for the revision. It's not specific to the statement of cash flow, but it permits to understand why the cash is different from what I see in the P&L. So, and if you want, I can try to find a specific chapter about the statement of cash flow in another book. I can scan it because this one is not specific. It's a chapter about financial statements, cash. Oh, it's not the same. Explain the cash and what we'll see about the balance sheet, the different presentation of the balance sheet, how we can interpret, and the chapter 5 just after the exercise. It's about operational efficiency and equity. Yes, it's not specific. So I can scan for tomorrow one chapter about the statement of cash flow in one book. If you want to revise what is a statement of cash flow and to understand what we did about this document today, yes, I can do that. Yes, chapter 4 and 5. So I put now the chapter 4 and 5 in the files. And so chapter 8, November, analyzing, is not here. Sorry, it's not this one. It's this one. This one, textbook. And I will put in the session 1. So the name is Cash Management Textbook. But it's not specific to the statement of cash flows. It's more in order to understand the differences between the cash and the P&L and how we can transform the balance sheet in order to see the cash. So I will scan another chapter about the statement of cash flows, okay? It's the third edition. Yes, what I put on the slide, it's a fifth edition, from the fifth edition, 2015. So 4 and 5. I finished to download it and I put it in the module of the session of today, okay? So you can read also the 2 chapters. It can be useful for the rest of the sessions. And for tomorrow, I will scan a specific chapter, maybe from another book about the statement of cash flows, okay? So see you tomorrow at the same time. And we continue with the statement of cash flows. And after we will see how to transform the balance sheet in order to interpret some problem of cash from the balance sheet point of view. Okay? Thank you and see you tomorrow.